Thank you for joining our latest virtual bank conference installment. I'm Ian Green. Today, Julienne Cassarino and I are having a conversation with Jay Hatfield, the founder of Infrastructure Capital Advisors. Jay has visited with us before, and we welcome him back. His firm manages several ETFs with over $2 billion in assets under management. His SCAP ETF, that's ticker SCAP, focuses on small cap stocks. We'll be sure to get his take on small cap banks. During his career, Jay has gained a broad perspective on the US financial markets with years as an investment banker, a research director, portfolio manager, and as a co-founder of a New York Stock Exchange listed company. Jay frequently appears or is quoted in Barron's, The Wall Street Journal, Yahoo Finance, TD Ameritrade Network, and Bloomberg Radio and TV. So let's get started. We're anxious to hear what Jay has to think about 2025. Julienne?
Great. Well, I add to Ian's comments. Thank you for being here. So the last time that we talked, about a year ago, you expected inflation to moderate in 2024. And even while it was still going up, and it did, it certainly, we certainly got that moderation. But now we're seeing that pretty much stopping, if not even changing direction. I was telling Ian, gas prices around here are up. I think grocery prices are up. Home prices don't seem to be, they seem to be going up. And so we're just wondering about what your views are on inflation for 2025.
Well, first of all, it's great to be on. Thanks, Julienne and Ian, for having me on again. Well, we have a differentiated view about both what is going on with inflation and what's likely to go on. And where we're most non-consensus is that our model, our economic models, show that Trump's policies are disinflationary, not inflationary. And we can get into that, but there's some nuances to it. The most important thing is focus on the dollar. Dollar's up at a high, up over 10%, very deflationary. And then, so that's kind of like what's prospectively going to happen. But historically, really inflation's right now at 2%. If you correct for the way shelter's calculated. So we use market, we have that on our website, CPR-R, it's under 2%. So the BLS uses a very purposely delayed 6-month index. And then they also do renewing rates, which are also delayed by another year. So inflation on housing now, well, it ticked up last month, which is disconcerting, but it was as low as 0.2. So that's 2.4 annualized. And if you just project that forward a year, then we would get to like 2.1, 2.2 PCE core at the end of the year. So we think there's a misperception that inflation has ticked back up, but it's understandable, as you're pointing out, that you can't put the genie back in the bottle, Julian. So we follow the quantity field theory of money. So the money supply grew 60%. This is over the pandemic. GDP nominal grew 38. So if monetary theory was correct, then the price level would be up 22. Well, guess what? It was up 22. But 22 is a lot. So I was having lunch with a friend, kind of to your point, Julian, and she said, well, God, I hope Trump does something because I can't pay, I mean, this is Manhattan, but $7 for lattes anymore. And I was like, well, same thing. You can't, I don't think lattes are going to cost $3 in New York. We do have things that nobody discusses, like higher minimum wages do put some cost pressure on. That's more important than immigration policy, by the way, in our opinion. But so there are certain categories. We're not going back to where we were. Prices are way higher than they were 5 years ago. People are not happy about that. But from an economic perspective, we should continue to decelerate. And in fact, the end of this month, when it gets reported a month and a half from now, or a month from now, we had 0.5 CPI. So we're likely to do 0.2 or 0.3. So it's going to come down year over year pretty hard over the next 3 or 4 months.
Okay.
So with that in mind, what how do you see interest rates? What is the Fed going to do? And what is this? I mean, for a lot of our investors, the shape of the yield curve, whether we'll get a steepening of the curve, and how does that also impact mortgage rates?
Well, so it's important to note that most of the Fed are Keynesians. So they are all very worried about the labor market, which they think drives inflation. The history doesn't show that, but that's what they think. So they're very concerned about immigration policy. We're not, because we don't think it's significant. And also minimum wage increases have created a surplus of low wage labor. But the Fed has incorporated their pessimism about Trump policies in their forecast. They've admitted that or said it. I don't know, admit's probably too strong a word. So they raised their inflation forecast from 2.1 to 2.5. So it's already in the market. There's massive pessimism about Fed rate cuts. There's at one point there was like 15 basis points. Now there's 22 basis points of cuts priced in. Keep in mind the Fed itself said 50. We're at 75 to 100. But the real numbers where the rubber hits the road is what we already discussed. If inflation does tick down in the first quarter, the Fed almost certainly will make another cut, not in January, but probably March or the following meeting. And the entire increase in long-term rates came from expectations of the terminal rate. So the easy way to think about the yield curve, the normal spread between Fed funds and the 10-year is 100 basis points. So if you believe the Fed's going to stop raising rates, like this is what Steve Mnuchin said today on CNBC, he thinks the Fed will stop at 350 and the 10-year will be at 450. Or more importantly, he thinks fair value on the 10-year is 450. Well, that means the Fed will stop at 350. So you kind of have to predict both of those numbers together. But as you're implying, like it's not sustainable where we are now. We're at 425-ish, 430, 10 years at 450. It's only 20 basis points of upward sloping. So one of those two has to change. Some bears, particularly Trump dislikers, or at least don't like his economic policy, think it's going to go to 5.25, I guess. We think the Fed funds rate has to come down to say, 2 3/4. We're more optimistic than most. But so that's one indicator of how tight the Fed is. So they're super tight right now. The other indicator I'd recommend to everyone is to keep the rates as high as they are now. The Fed has had to shrink the money supply 4% year over year. They normally increase at 5%, so that is deflationary. I don't think that's going to translate, like I said before, into $3 lattes in Manhattan, but it should continue to put downward pressure on prices.
It's curious, a lot of market commentators will come on and say, well, the market is expensive. It's 23 times or something like that. And there's a brief kind of flossing of interest rates in that discussion. In any of your work, have you ever come across the real relationship between rates and PE ratios? I mean, given where we are now, is 23 really high? I mean, I think in 1999 or so in the dot-com, I think we had higher rates or equal rates, and the PEs were higher, I think. I don't know.
True. Yes. So what we do to estimate the fair value of the market is we do a discounted cash flow. And to do a discounted cash flow, you have to know the 10-year treasury. So it kind of gets to your point that that's directly related. And then you have to assume the growth rate, which we assume perpetual growth rate of 4%. So we have a 22 multiple. We have a 7,000 target on the S&P this year, which is based on, of course, 26 earnings, right? Because it's the end of the year target, and 22 times our estimate of 2026 earnings. But I have said a number of times when people have asked, particularly on television, well, what if you're wrong about your forecast for 375 on the 10-year? Well, the answer is, I don't think this is going to happen, but every 25 basis points is a full S&P multiple. I mean, it's theoretical, okay? So if AI is booming, sort of your point, maybe we get like a late 90s speculation in AI, and that offsets. But your investors are more yield and value oriented. You know, small cap banks definitely very yield and value oriented. So if we're wrong about rates, maybe we get to 7,000, probably not. I don't think we'll go to, the implied would be like 5,500, so down from here. I don't think it'll be that bad, but it definitely puts pressure on the multiples, should not be ignored, is a key driver. And rates are lower than they were in the 90s, but also corporate tax rates are lower, so the growth is higher. So I wouldn't use just, oh, like when I was a kid, the multiple was 10, because corporate tax rates were 35 when I was a kid. So, you know, if
Right.
something's way less tax, it's going to grow faster and have a higher multiple.
Did you talk about mortgage rates? Do you expect mortgage rates to, which I guess largely priced off of the 10-year, right? To, you mentioned the 30. Yeah, what do you expect for mortgage rates?
Well, that's really the heart of why we don't think the 475, 480 level on the treasury is sustainable. Because in this market, everyone, well, notwithstanding recent market activity, but mortgage investors are requiring an above normal spread for putting money to work at what has historically been a high coupon for rates. In other words, they're charging money because, of course, you can prepay your mortgage. So they don't want to get 7, you know, if rates stay high forever, but then get nothing because everything gets prepaid. So they're charging an unusually high spread over 10-year, roughly 250. So when we're 2.5%. So when we're at 475, that means a 30-year mortgage. We use bank rate, but you can, Freddie is usually a little bit lower, but the bank rate number is like 7.25. So we don't think that's sustainable. So we think rates have to come down. We're already in a technical housing recession. We've had 2 quarters of negative investment in housing. So a decline in housing investment. So, and that was before the 100 basis points increase in the 10-year. So we think the best cure for higher rates is higher rates. And so you're right to focus on mortgages and the housing market, because that's caused 11 out of 12 post-World War II recessions. And the one that it didn't was really more the exception than the rule, and that's the dot-com bust. That was barely a recession. That was a negative 0.6% recession. So to have a deep recession, you have to have a housing bust. We think it'll be offset by tech investing, but still slow down in the economy if we don't get at least a 4, maybe. I mean, our range is 350 to 4. So if we got to 4, I think housing would stabilize or even improve, and the economy would continue to grow around 3%. But if rates go to 5, 4.75, we think we'll have a slowdown.
Okay, so very sanguine on short-term rates going down, a steepening of the yield curve, even if the 10-year or mortgage rates come in a bit, still a better shape to the yield curve, and then inflation slowing down pretty quickly and pretty soon. So how do you feel about credit quality at this point, particularly for commercial real estate and especially like office commercial real estate?
Well, I think it's already been proven out, but we said this 2 or 3 years ago, that there was an excessive amount of agita about commercial real estate. Not to say that there was no problems, but Barry Sternlicht and others would get on television saying like it's going to be cataclysmic, but it's really unfolded the way we would have expected, which is, yes, there are a lot of underwater, particularly office buildings, but other categories as well. Even some single family, particularly in New York City, because it's rent capped. But the capital markets are pretty efficient, way more efficient now than they were 20, 30 years ago. So what happens? You give it to the bank. Just default. That's what's good about a mortgage. You just hand it over. Banks probably, you know, take a little bit of write-off, but it's not a wipeout. The problem with those, I think what the issue is, everybody thinks is, or thought at least, it was going to be like 07, 08. But keep in mind there, when you had a default, it was 100% wipeout. If you make a loan on a $100,000 house and they default, you can't repossess it even for 100 or for 50,000 maybe. But with commercial real estate, almost always, if you default, it automatically, there's no even requirement to foreclose. It just goes automatically to the lender. So it's much more orderly. There's lower losses. There's all these private equity funds bidding to buy those defaulted mortgages from the banks. So we think the losses are manageable. That seemed a little bit crazy a year or two ago, but that's really the way it's unfolding. And also credit quality, the best indicator of individual credit quality, not commercial mortgages, but that's a big issue for banks, is individual credit, is employment. So as long as we don't have mass layoffs, like we think we'll have maybe an employment slowdown, but because of tech, not the normal recession type crash in employment. So we think credit quality slightly pressured for low income people who don't own their own homes, but will continue to be manageable. Reserves are adequate. So we're bullish on banks, regional banks. We're actually more bullish on investment banks, but that's more because of the AI IPO boom and deregulation of antitrust. But the deregulation of antitrust could, particularly for very small banks, could be super positive too. And so we do like small banks or big holding in SCAP.
Right, right. Yeah, I think when we spoke last time, you'd recently launched SCAP, and I'm not sure what your original allocation to financials was at that point, but where does it sit today in your portfolio?
We're right around 25%. We do think that the Fed is, like we said already, but going to cut rates. You know, even if we're wrong, still 50. They said they were going to cut at 50. And so that's good for regional banks. I think the economy is going to be strong. It's good for regional banks. So we like high quality regional banks, like our largest holding in SCAP, not our largest holding, but our largest bank holding is like East West Bancorp, high quality, small cap bank, well capitalized, growing earnings, you know, paying reasonable dividends. So we think that this is still, notwithstanding all the commentary to the contrary, a good year to own financials. And probably really, if I think about it, small cap banks, because they benefit from consolidation, and super large cap banks that actually get fees from consolidation, like Goldman Sachs and Morgan Stanley.
So you have another ETF called ICAP, ICAP is the ticker, and that's large cap. Do you have what's your weighting to financials in that?
That's a similar number, which is close to what the index number is, about 25 as well. But there we do have more of a large cap GSIB investment bank focus. We have a lot of Citi. We do have some regional banks, you know, US Bancorp and some others. Fewer smaller ones, obviously, I guess, because that would be an SCAP and not ICAP. ICAP is average market cap's over 100 billion. But our biggest positions are Goldman, Morgan Stanley, Citi's, like has some investment banking, but it's a recovery story. Those have been great calls. Hopefully we mentioned it last time we talked, but we've been on Goldman for the last year. But we think it's now even going to accelerate more, and we're carrying consensus estimates that are 30% above the street, because we're more optimistic about investment banking than the market is.
And you know, you've also have two REIT preferred. You have a REIT preferred ETF, and you have a general preferred ETF. And we discussed last time when you were on, you gave us a nice primer on preferred stocks. You know, preferred stocks have come up a lot. It was a good place to be over the past 12 or 15 months or so. So what's your outlook on that? Given rates, I guess you're probably still constructive, no?
We are, and there's a simple way to invest in preferreds. And our fund was launched when the preferred market was normal at $25. So it's a pretty good approximation of where the underliers that we have. So you buy preferreds, they're callable at 25. So you buy them when they're well below 25, like now, they're 22. They're not as cheap as they were last year, to your point. They were like 18 last year, but you buy them at 22, And then when they get to 25, you can lighten up a little bit. I wouldn't sell them all, but I'd lighten up a little bit. Because there's always a new, unfortunately, there's always a new dislocation. And preferreds are more volatile than bonds. In fact, we launched a new bond fund, BNDS. And if you look at the data there, bonds are about half as volatile as preferred stocks. Creates fewer opportunities, they get less discounted. So we think preferreds will outperform, probably outperform high yield bonds. You'll get your coupon plus some capital appreciation as we drift closer to par.
Mm. I once had a professor do, you listen to the music, but you watch people's feet. So, for you to launch a bond fund here, you must be pretty constructive on either, depending on what you're focusing on, but either on the direction of interest rates or credit. And I'm not sure what your focus is in that. Maybe you might want to talk
Well,
about that.
both. It's a higher spread product, so it yields 8. And so we're looking for credits that our models show have low default risk, but other people are worried about. A good example, like SC Corp Preferred J, that's Southern California Edison. It actually hasn't traded down that much, but it's traded down with the fires. But we look at our models and say, there's no risk of a default. There's risk to the equity, but not of a default. So we are looking for credits that yield more, but still have modest default risk. And so that those companies benefit when the stock market's strong. We have a very robust target on the S&P, so that they should do well. And then they're less sensitive to interest rates, but of course it's a huge tailwind if interest rates are coming down. In fact, didn't time this. It was perfect, but it wasn't our brilliance. But when we launched the fund on the day CPI came out and printed very cool. And so we're up 1% in like 4 hours of trading. So not that we're not day trading our ETFs, but we do think that we'll end up in that 4% area, 3.5 to 4% area. That'll be good for bonds, but more importantly for high yield bonds. The stock market's more important for high yield bonds. So if the stock market's higher, it doesn't have to get to 7,000. Spreads should continue to tighten. So you should get a good total return, not just get the coupon, but do better on a total return basis.
When we last talked, we talked about your new small cap fund and about overcapitalized thrifts. And you mentioned that you were going to take a look at them. They're overcapitalized. They tend to have less credit risk. They are more interest rate sensitive, perhaps. So falling rates should go more to their bottom line. I was just wondering if you ever just wanted to follow up on that, if you did look at them, if you bought any, if you have any thoughts about them now?
Yeah, we did, and SCAP, and you should look at anybody's interested in SCAP should look at the data on the website because that's a big compliance issue. But we significantly outperformed other small cap funds, and it was for precisely that reason that we did have exposure to financials and REITs too. REITs, even though rates ticked up at the end of the year, did do well last year. So like a Kilroy, I mentioned East West Bancorp, Pinnacle Financial. So our models show are high quality, well capitalized companies in good growth markets. So that's done well. And if we're at least half right about rates, we'll continue to do well this year.
Right. So we'll kind of wrap it up, but let's do a little summary of your predictions. Maybe if you can kind of just summarize and the surprises that you think have a high probability or higher probability of happening.
Well, so I think that the economy will be strong and inflation will be modest, which doesn't fit the market's Keynesian models. That's our number one non-consensus call. And then the other call is, so that's on the bond side. On the equities, 7,000 is the highest target I've heard. But I should note, which I didn't get a chance to before, that is dependent on a corporate tax reduction. So I would just urge your viewers to not obsess as much about immigration, and tariffs, and think about tariffs almost as positive in that provides revenue that could fund the corporate tax decrease. And that is unambiguously great for stocks, but nobody ever talks about it. Like, it's not discussed by media, politicians don't care about it, but we as investors should absolutely care about it. Directly translates into higher earnings, higher multiples, because you can grow earnings. Banks are a good example. If you pay less taxes, you get to retain more earnings. When you have more capital, you can earn more. And so there's a misnomer that growth in earnings comes from high GDP growth, but it really almost 100% comes from retained earnings and the return on invested capital. So watch, that would be our number one indicator for the year. What happens to the corporate tax rate?
And if we don't get a change, if it stays the same, because it might be unlikely now that it rises, but with at least in this first
So we'd
2
like
years.
numbers. So our target drops from 7,000 to 6,600.
Okay,
So
Which is still up like 7-8%, right? Or
yeah, so it's still a big good year. Now, if we're wrong about everything and rates are at 5.5 and the corporate tax rate doesn't decline, then we could have sort of a flattish year. I don't think that'll be the case because, you still have tech supporting the market. It's going to be consolidation. It's going to help small cap banks. It's going to help the investment. So there's going to be a lot of sectors of the economy and stocks that are doing really well. But like probably if we got an 18% corporate tax rate, the risk to our target would be to the upside for all those reasons I discussed. Like, it does matter, regardless of your politics. It's important to separate politics from economics, because it's perfectly reasonable to support certain candidates for social reasons and other reasons, but it's unambiguously great for stocks to have pro-business, deregulated minded governments. You may hate a lot of other things about them, but if you care about your stocks, it does matter. So that's a huge tailwind that, probably the no corporate tax rate 6,600, we probably still get there even if rates are like 4.25. So there's a lot, like the card count, if you play blackjack, is really good this year. So I wouldn't get too focused on these kind of political talking points about tariffs and immigration and miss the positive business environment, deregulation, that's historically been great for stocks. And I mean, it's already been, and that's what's been reflected so far.
interesting. Well, that sounds great. Well, we
yeah,
really
hopefully
appreciate.
that extends over a year. Hopefully it's we don't
Right.
end
Well,
up.
we look forward to having you back again, maybe towards the end of the year. We can see how, now you're on the record, Jay, so.
It's good.
Last year you
record.
did very well. We'll see about
Yeah.
number 2. All right, we appreciate your time, Jay. Take care.
Thank you.
Thanks for having me
Thanks.
on. It was great questions, great discussion.
Good to see
Great.
you.
Bye-bye.
Okay, bye-bye.